We want to discuss trade wars and tariffs. Trade wars and tariffs, understanding their impacts on global markets, the impact of tariffs and trade wars on global market. Trade wars and tariffs have significant effects on global stock markets, influencing investor sentiments, corporate profitability, and as well as economic growth. So here is our breakdown of the impacts. We want to highlight the breakdown of impacts of trade wars and tariff on global markets. Number one is economic slowdown and global growth. Economic slowdown and global growth. So in this context, we want to highlight reduced trade volumes. Reduced trade volumes. And so trade wars and tariffs increase the cost of imported goods, discounting international trade and slowing global economic activity. Not only that, there's supply chain disruptions. Supply chain disruptions. So industries, depending on global supply chains, face higher costs and delays, leading to reduced efficiencies and lower earnings. Then there's recession risk. Recession risk. So prolonged trades, conflicts can weaken economic global supply. It can actually, it can weaken the overall, economic growth of a typical economic entity, potentially pushing economies into recession, which negatively affects stock markets, worldwide. Number two is corporate profitability. Corporate profitability. So in this case, higher cost for businesses. There's a relatively higher cost, higher than normal cost for businesses. So tariff increase input costs for companies relying on imported goods, squeezing profit margins. Then there's consumer impacts. Companies may pass, on higher costs to consumers, leading to reduced demand, especially for discretionary goods, thereby affecting revenue. Before then, you have export-oriented sectors. For export-oriented sectors, industries heavily reliance on exports, such as automotive, technology, and agriculture, are particularly vulnerable to declining overseas demand. If the tariff will lead to kind of declining overseas demand for their products, then of course it's going to affect the company or the sector involved negatively. Number three is market volatility. Market volatility. So in this case, it incorporates uncertainty. Trade wars create uncertainty about future policies and economic conditions, leading to increased market volatility in this regard. So investors often react strongly to trade-related announcements, or escalations, as the case may be. We also consider sector-specific volatility. Sector-specific volatility. So in this context, we're talking about the issue of having, trade wars and some other aspect of. So we're considering sector-specific volatility. So in this case, certain sectors, will then be exposed to volatility more than other sectors within the markets. So number four is currency and commodity markets. Currency and commodity markets. So we want to discuss currency appreciation. So countries are involved in trade wars may experience currency devaluation, impacting multinational corporations and their earnings. So in the case of commodities, it discovered that tariffs on raw materials like raw materials like aluminium, like iron ore, affects commodity prices and related industries, including mining and construction. Number 5 is global diversification impacts. Global diversification impacts. So you have interconnected economies. The world is like a global village, and finance is global. So there's that issue of interconnection between different countries, different economy in the world. So in a globalized economy, trade wars impact not only the countries involved, but also their trading patterns. So this interconnectedness, spreads the effects across global markets. What happens in a particular country could equally affect, other countries as well. Then there's emerging markets. So emerging economies they are often reliant on exports. They are particularly vulnerable to trade conflicts, leading to stock market declines in these regions. Please like this video and subscribe to this channel if you've not done that. Number 6 is investor sentiment. So in this case, there's that issue of risk aversion. Investors become kind of risk averse. So trade tensions can increase risk aversion, prompting investors to shift towards safe haven, such as gold or government bonds, thereby pulling funds out of equity. Whenever they become risk averse, they tend to divest from riskier assets into safer assets like bonds and even cash, and other related safer asset classes. There's kind of market optimism. There's market optimism in this context. Conversely, resolutions or temporary trade agreements may boost investor confidence, leading to market rallies. Number 7 is impact on specific markets. Impact on specific markets. Let's consider the case of U.S. and China. The U.S.-China trade war, has shown how tariff can directly affect the world's 2 largest economies, leading to global stock market ripples. Not only that, there's the issue of the European Union. And so trade disputes involve major economies like the US and the EU can affect sectors such as automotive, agriculture, and even aerospace. Number 8 is long-term effects. Long-term effects. Shifts in trade patterns. Persistent trade wars may cause companies to relocate manufacturing or diversify, supply chain, impacting regional economies and stock market dynamics. So it's a very complicated matter actually. Whenever there's trade wars and tariffs, the effect is really significant. It's quite significant. And then there's disruption or the coupling of economies. The coupling of economies. So in this regards, you discover that if trade wars lead to economic decoupling, markets may witness structural changes in investment flows and market correlation. So what are the key takeaways here? In summary, trade wars and tariffs introduce uncertainty and inefficiencies into the global economy, so leading to market volatility and sector-specific challenges. While short-term reactions can be severe, the long-term impacts depends on the resolution of the trade dispute and how businesses and economies adapt to the changing environments. The investors should monitor trade development and diversify their portfolio to mitigate risk. So whenever you come across the impact of trade wars and tariff, the best thing to do is to diversify your portfolio so as to be able to mitigate the risks we have just explained in the course of this video.